The claim that broke everything. Last October, a couple from Pensacola, Florida, we will call them Dave and Linda, woke up in their 2021 Jayco North Point to a ceiling that was dripping water. Not a slow drip, a steady stream pouring through the bedroom slide-out seal. They had owned the rig for 3 years, paid cash, kept up with every maintenance appointment, and they had full coverage, RV insurance through one of the top 3 national carriers, $218 a month. They filed a claim. 7 days later, the adjuster showed up. He spent 20 minutes looking at the ceiling, took a few photos, and told them the damage was caused by a failed seal. Not a storm, not an impact, a failed seal. Then he said 4 words that changed everything. Those words were, "That is not a covered peril." The repair cost $11,000. Their insurance paid $0. When Dave called the home office, he learned something that every RV owner in America needs to hear, something the insurance industry has been quietly building into your policy for the last decade. Your RV insurance does not work the way you think it does. And today we are going to show you exactly where the gaps are hiding. The named peril trap. Here is the first thing nobody explains to you when you buy an RV insurance policy. Most homeowner policies are what the industry calls open peril. That means everything is covered unless it is specifically excluded. Your house burns down? Covered. A tree falls on your roof? Covered. Unless fire or falling trees appear in the exclusion list, which they almost never do. RV insurance is the opposite. The vast majority of RV policies are named peril. That means nothing is covered unless it is specifically listed. Fire, theft, collision, hail, windstorm, lightning, explosion. If the damage was caused by something that is not on that list, you are paying out of pocket, period. And here is where the industry earns its money. The list of named perils has not changed in 15 years, but the ways an RV breaks have changed dramatically. Slide-out seal failure? Not a named peril. Delamination from ultraviolet exposure? Not a named peril. Roof membrane separation? Not a named peril. Black tank sensor corrosion that leads to an overflow and destroys your flooring? Absolutely not a named peril. These are the 5 most common types of damage that RV owners experience, and not a single one of them is covered under a standard policy. The insurance company knows this. They have run the actuarial tables. They know that the average RV will experience at least one of these failures within the first 6 years of ownership, and they have structured the policy so that when it happens, the claim gets denied. Legally, cleanly, with a paragraph number they can point to. You are not buying peace of mind. You are buying collision coverage wrapped in language that makes you think you are protected against everything else. The depreciation machine. But let us say you do have a covered claim. Let us say a hailstorm shreds your awning and dents your sidewall. That is a named peril. Hail is on the list. You should be fine, right? Not exactly. Most RV policies use what is called actual cash value, ACV, not replacement cost. The difference will make your stomach turn. Replacement cost means the insurance company pays what it costs to fix or replace the damaged part at today's prices. That is what you would expect. That is what most people assume they have. Actual cash value means they pay the replacement cost minus depreciation. And here is the kicker. The insurance company decides the depreciation rate, not you, not an independent assessor, the carrier. Let us use real numbers. Your awning gets destroyed by hail. A new carefree awning with hardware and installation runs about $2,800. Your rig is 5 years old. The carrier applies 40% depreciation to the awning because it is a wear component. Your payout is $1,680, minus your $500 deductible. You receive $1,180 for a repair that costs $2,800. That is a $1,700 gap on a claim that was approved. Now multiply that by every component on your RV. The roof membrane, the slide toppers, the exterior graphics, the tires. Every single one of these gets depreciated at a rate the carrier controls. And those rates are not published anywhere in your policy documents. They are calculated internally after you file the claim. You are paying monthly premiums for a policy that, even when it pays out, covers less than half the actual repair cost. The full-timer exclusion. And now we arrive at the clause that catches more people off guard than anything else in the RV insurance world. If you live in your RV full-time, your standard RV policy may not cover you at all. Most RV insurance policies are written under the assumption that the vehicle is used recreationally, 30, 60, maybe 90 days a year. The moment you make that RV your primary residence, the moment you change your mailing address to a campground, or you stop paying rent on a house, you have triggered what the industry calls a use change. Buried in Section 4 of almost every major RV policy is a clause that says coverage is void if the vehicle is used as a primary dwelling without a full-time endorsement. Here is what that means in practice. You have been living in your RV for 2 years. You have a house fire, a propane leak, an electrical short, whatever. You file a claim. The adjuster asks for your permanent address. You give them the campground. The claim gets flagged. An investigator pulls your DMV records, your mail forwarding, your Amazon delivery history. They determine you are a full-timer. The claim is denied, not reduced, denied. And that full-time endorsement they want you to buy? It typically adds 40 to 60% to your premium, and it comes with its own exclusions. Most full-time endorsements don't cover personal property above a certain threshold. Some exclude liability for injuries that occur inside the RV. A few don't even cover the RV if it is parked in the same location for more than 90 consecutive days, which eliminates every seasonal camper and long-term boondocker. The industry has created a product that is too expensive for most full-timers and too restrictive for the ones who can afford it. What the smart owner actually does. So where does that leave you? Paying for a policy that does not cover the most common failures, that depreciates your payout on the claims it does cover, and that might be void entirely if you live in the rig full-time. Here is what the people who have been through the claims process will tell you. First, read the declarations page, not the brochure, not the website. The actual declarations page that comes with your policy. Look for the phrase named peril or specified peril. If it is there, understand that you are only covered for what is listed, nothing else. Print that list. Tape it to your dash if you have to. That list is your actual coverage. Everything else is marketing. Second, ask your agent one specific question. Is my policy actual cash value or replacement cost? If it is actual cash value, ask what the depreciation schedule looks like for a rig that is 3 years old, 5 years old, 10 years old. If they cannot answer that question, and most cannot, that tells you everything you need to know about how the claim process is going to go. Third, if you are a full-time RV owner or planning to become one, get the full-time endorsement before you make the switch, not after. The moment there is a gap between when you started living in the RV and when the endorsement took effect, every claim during that period is deniable, and carriers will check. Fourth, and this is the one that hurts, build a self-insurance fund. Set aside $200 a month in a separate account. Do not touch it. In 3 years, you will have $7,200. That is enough to cover the seal failure, the delamination repair, or the roof replacement that your insurance policy was never going to pay for anyway. The math is brutal but honest. If you are paying $200 a month for a policy with a $1,000 deductible and actual cash value payouts, You are spending $2,400 a year for the privilege of receiving 50 cents on the dollar when something goes wrong. That self-insurance fund gives you $1 for every dollar you saved. The question they do not want you to ask. The RV insurance industry collects an estimated $4.2 billion in annual premiums in North America. The combined payout ratio, the percentage of premiums that actually gets returned to policyholders as claims, sits at roughly 53%. That means for every dollar you pay, 47 cents stays with the carrier. Before investment income, before administrative recovery, 47 cents of your dollar never comes back. Compare that to standard auto insurance, where the payout ratio averages 72%, or homeowners insurance at 68%. RV insurance is the most profitable line in the personal property portfolio, and it stays that way because nobody reads the policy until the ceiling is leaking. Dave and Linda, they canceled their policy 6 months after the denied claim. They put the $218 a month into a savings account and spent $900 on a comprehensive roof inspection and seal replacement. Preventive maintenance that their insurance never would have covered and never would have paid for. Dave told us something that stuck with us. He said, "I wasn't paying for insurance, I was paying for the feeling of insurance, and feelings don't fix roofs." If you want to know which RV insurance carriers actually have the highest claims approval rates and which ones deny the most, we have pulled the data. That breakdown is coming in the next video.